So, John, let's start with your overall look, because your indicators have moved back and forth with some fairly quick speed over the last 8 months and often at very good timing. So what do they tell you right now, positive or negative on stocks?
They've been, in terms of short-term and tactical, they've been positive since the beginning of July. Prior to that, they had been positive since April the 6th. So there was a little wiggle in there back at the end of June. You probably recall that. There was a little bit of a chop in there, and some of the internals started to turn on that. But we've been tactically positive now since the beginning of July. There's a couple of little chinks in the armor that I'm seeing. The VIX had a nice little pop today, even with the S&P 500 up 20 at the time. Corporate bond spreads, just on a very near-term basis, are widening a touch. And everybody knows market breadth has been very narrow. So those are warning signs, but as far as the actual models are concerned, they're still positive. You can see the Asbury 6 here, and those two that I spoke of, the corporate bond spreads and the breadth, the NYSE market breadth. But otherwise, really amazingly, and this is why we're data-driven, is because when the market is, these are unusual times, to say the least. It's a 100-year pandemic. We have an election coming up, a lot of turmoil politically. So we just try to keep our heads down and watch the data. And the data has been, with very few exceptions, it's been positive since the beginning of April.
Yeah. So, John, you've got a few blips on the radar that you're watching, but still positive on the market. Breadth, yes, noted, credit spreads you mentioned as well. Some of the reports of sentiment, too, I've seen are starting to creep pretty high. Is that becoming a bull killer yet, the fact that there's so many bulls? What do you see in terms of how you gauge sentiment getting overly frothy?
Excellent question. And what I've learned over the years is you have to be able to differentiate between a tactical signal, which is what our correction protection model, or CPM, and Asbury 6 are, and strategic indicators that kind of tell you where you are within a normal environment. And you just mentioned a couple of them. Sentiment is as high as it's been in several years. We look at several surveys. I like the surveys because human nature, when everybody's really bullish, that's usually when you're near a top. It doesn't mean to sell. It's not an actionable signal, but it is there right now. The other thing is put-call ratios have been extremely low. Nobody's buying insurance. Everybody's of the belief the Fed has their back. Asset prices will never really seriously deteriorate again, and that's the mindset. Now, the third one that I was just actually looking at before I came on, a second before I came on, is I was looking at the percentage that the S&P 500 is above its 200-day moving average. And I didn't even count today yet, but through yesterday it was 13%. Historically, 12 is that area that you should, if you're looking at this in baseball terms, when you're 12% above the 200-day moving average in the S&P 500, you're going into the top of the ninth. And you need to be aware of where the exits are so you're not the last guy out of the ballpark. And that's kind of where we are right now. You can have an extra inning game, you can go 12. But right now, just for perspective, the beginning to middle of February, that metric got to 11.5% up above, and we're 13 now. So I'm watching the indicators. I'm turning over rocks right now here to see. That's why I mentioned the VIX earlier. The VIX had a little bit of a bump up today. We're looking at the 21-day moving average at about 2290, and we were up above that today, even as the S&P 500 was 20 higher. So I think we're getting close. I think we're in the ninth inning, but as long as our models stay positive, we're just going to keep dancing until the music stops.
So, John, we're dancing right now. Maybe we'll dance too fast and we'll fall if the sentiment just keeps climbing. But right now, it's not enough to overwhelm the other signals that you see. In terms of where there has also been pretty positive sentiment outside of stocks, gold has been a place that seemed to work no matter what was happening over the last year, basically. First, it started before COVID and then quickly rebounded to new heights over the last couple months, then stopped out basically earlier in August. How do you assess gold right now? What do the technicals show you? What is the rejection potential from some of those previous highs? I mean, we got there to like multi-year highs and we kind of got hit real hard quickly.
Gold's come a long way really fast. One of the metrics we pay a lot of attention to is we watch asset flows in and out of the ETFs. There's about 200 ETFs that we follow. Obviously, all of the the usual ones, the spiders and the Qs. We also watch GLD and XME, which is a metals and mining. And I just wrote a report earlier today. Maybe that's what you're referring to. But the total assets invested in GLD moved into a monthly trend of expansion. I don't have the chart in front of me, but around March the 23rd, we had a nice move up. GLD actually stalled at the highs, the old highs that we made at 2011, in the year 2011. We exceeded them, but then, the brakes were thrown on and now we've backed off. So I've been watching those flows very carefully. And since the 20th of this month, they have actually moved into a emerging period of contraction. So we just put a note out to our clients this morning, those that had been long per our signal back in March, this is a good place to have an exit plan, if maybe not even take a little bit off the table. You could always put it back on, but gold looks vulnerable now. You've got support underneath, about 2 to 3% underneath GLD. But it looks vulnerable, and if we break those support levels, which again is approximately 2% underneath the market, I think we can see a much bigger move downward. There's a lot of money in gold. I think there's a lot of Johnny-come-latelys in gold. The market looks a little top-heavy. So that's one that we're watching, and we wanted to make sure our clients were aware of that so they don't turn a good trade into a mediocre one.
All right, I like that point, John, and a good, clean analysis of the levels, right, where the view on the asset depends where it goes, but looking for that top heaviness. We'll see if it breaks down 2% below from here, if that can accelerate it. If not, then we'll watch for stability. I mean, the trend still long-term has been strong to your point here that we've seen. Johnny-come-latelys to the gold party. Interesting. Hey, you got one more, John, before we let you go. MCHI is one of the China ETFs that you've got on your mind. It looks like maybe it's also poised for a big move, but in terms of direction, it seems a little bit tough to figure out.
I track, I think, 64 different foreign markets, and many of those have a linear correlation to the S&P 500. So we are looking at those because sometimes you'll see a chart pattern, sometimes you'll see something happen overseas on one of these correlated markets, and you won't see it here. So the MCHI actually broke out. If you look at that chart, the upper right edge, you see that kind of congestion that we've had going on for the past couple of months, and we broke out of there. That's an indication that we're getting new flows in there. You're getting a new surge of buying in there. And it looks like we have about another 5 to 6% higher to go in MCHI. So considering the linear correlation between MCHI and the spider, SPY, as long as this pattern remains intact, it gives us a general idea of how much higher that we could go in the S&P 500. We also have a pattern in the Dow 30. Very similar pattern that targets 29,400. It's close. We're not quite there yet. But those are some near-term patterns, both in MCHI and in the Dow 30, that I think we could see here perhaps over the next week or two, exhaust all of these chart patterns. And then again, keeping really close eye on volume and flows into the spiders and the Qs in corporate bond spreads and how stocks are performing relative to bonds. We're looking at all those really close because once those start to roll over, that's going to be a sign to us that we are going to get this pullback that some of these strategic indicators that I talked about are kind of flashing a yellow light.